Hello and welcome back. It has been quite some time since my previous upload, but I had been quite busy with some things that took my attention away from this channel. But now I'm back and hopefully I will continue to upload more consistently. To kick off 2026, I wanted to talk about an ETF that was released quite recently and has been quite popular in the income investing community, mainly because of the high yield it is targeting. It is the Evolve US Equity Ultra Yield ETF with the ticker symbol BIGY. 2025 was a great year for covered call ETFs, especially in the Canadian market. There were many new ETF releases, but one ETF that stood out from the rest was the Harvest Diversified High Income Shares ETF with the ticker symbol HHIS. This ETF mainly serves as a one stop solution to all of Harvest's single stock high income shares ETF. In case you're wondering why I am talking about HHIS all of a sudden, it is because when Evolve came out with their BIGY ETF, most people saw it as a competition to HHIS. This is not an entirely incorrect opinion to have. After all, both ETFs hold big tech companies and use leverage and covered calls to generate higher income. But the way both ETFs are structured and the overall aim of both ETFs is quite different. In fact, when it comes to overall ETF strategy, I think the BIGY ETF has more in common with the Ulti ETF from YieldMax than it has with HHIS from Harvest. I say this because the way BIGY chooses its holdings is very similar to Ulti. So, in this video, we will review the BIGY ETF and understand how it has been designed to combine the best elements of Ulti and HHIS, resulting in a product with a yield of 30%, while at the same time minimizing the risk of capital erosion. As mentioned earlier, the BIGY ETF has borrowed elements from both Ulti and HHIS and made some tweaks to further improvise on those strategies. Let us take a look at what those similarities and differences are. First, let us compare BIGY and HHIS. The similarities include that both hold big tech companies, both use leverage and covered calls to generate higher income, and both write covered calls on up to 50% of the underlying holdings. At the same time, there are two key differences that distinguish both these funds. First, BIGY uses a 33% leverage as opposed to HHIS using 25%. This is aimed to increase its overall yield, but also increases the risk of underperformance during a bearish market. The second difference is that HHIS aims for sector diversification, whereas BIGY aims for volatility maximization. This relates to how both these ETFs choose their underlying holdings. At first glance, this may not seem like a major difference because both ETFs have underlying holdings that overlap. But if you sit back and think about it for a moment, HHIS is aiming for a more balanced approach for its holdings, whereas Big E is aiming for maximizing income. This difference is quite apparent when we look at the sector mix for both ETFs. HHIS holds stocks like Eli Lilly and Costco, which provide some defensive cushion during market downturn. In addition, Harvest has filed preliminary prospectus for six new ETFs, which would further increase the sector diversification if included in HHIS. On the other hand, if we look at the holdings of Biggie, we see that it is classifying Tesla under consumer and cyclicals, and Amazon, Alphabet, and Meta under communications. I would like to reclassify these companies as technology because that is the primary source of their revenue. Also, I would reclassify strategy as financial because what they are doing with Bitcoin is mainly a financial innovation, making them a direct competitor of banks. With this reclassification, we can see that Big E is about 80% technology and 20% financials. Both these sectors have historically been very high performing, but also tend to go down dramatically during bearish markets. Given the fact that BIGY uses a leverage of 33%, the downside could be significantly higher in BIGY compared to HHIS during a bearish market. And this is where I think the BIGY ETF diverges away from HHIS and enters into the ULTI territory. The major difference I just highlighted between BIGY and HHIS also happens to be the one but highly important similarity between BIGY and ULTI. Both ETFs prioritize volatility when choosing their underlying holdings. We can see this being clearly mentioned on ULTI's homepage, where they confirm that they choose between 15 to 30 of the most volatile stocks, rebalancing as needed. Biggie, while also prioritizing volatility, uses a safer version of the strategy. Biggie's approach is best explained by their CEO, Raj Lala, in this short recording, which I borrowed from the channel Passive Income Investing. Let's hear it.
Yeah. So first, what we decided to do was we started with taking a look at the 25 largest stocks by market cap on the S&P 500.
Okay.
And then from there, we took a look at the stocks that had the potential highest option premiums that we could generate from a yield perspective. And we also wanted to have some crypto exposure. So we really like Coinbase, we really like MicroStrategy or Strategy as well. So we took effectively 8 of those 25 largest companies that had the highest option premiums, and then added in Strategy as well as Coinbase. That's kind of how we developed the portfolio.
We can see that Biggie is minimizing its risk by making sure it is choosing 8 most volatile stocks from the top 25 S&P 500 companies by market cap and 2 largest companies with Bitcoin exposure. While this approach is safer than the one used by Alti, it is still an approach which prioritizes volatility over a balanced portfolio. In addition to this, there are some obvious differences between Biggie and Alti. Biggie uses direct leverage, whereas Alti uses synthetic leverage by using a mix of call and put options, which mimic a particular stock's price movement, thus providing a leveraged effect. Personally, I would prefer Biggie's approach of directly holding the stocks. Another key difference is the percentage of leverage itself. Biggie has a fixed 33% leverage, whereas with Alti, the leveraged effect provided by its synthetic holdings could vary from one stock to another. Also, Alti sometimes uses triple leveraged ETFs such as TQQQ. Even a broad market index fund, when leveraged to such a high degree, could end up being very unpredictable. Last but not the least, Alti tends to have a high turnover of holdings, whereas Biggie aims to have a relatively fixed set of holdings, rebalanced approximately every 3 months. If we look at the current holdings of Biggie, they haven't changed since inception. On the other hand, Alti tends to rebalance and change its holdings on a weekly basis. So, in conclusion, where does Biggie stand when compared to HHIS and Alti? Is it a better or worse investment? I would say it definitely has its place in an income oriented portfolio, but it is important to understand what it is designed to do. This will help us understand what percentage to allocate within the portfolio. On the surface, it seems similar to HHIS, but that is definitely not the case. The way it chooses its holdings is similar to Alti, with some safeguards to minimize the downside. Overall, I like to think of it as a mix between Alti and HHIS, combining the best elements of both ETFs. My expectation is that this ETF's price will continue to fluctuate between $20 and $25 while it pays out approximately 30% yield. At the same time, I would not be surprised if there is a slight drop in the payout amounts in the future. Evolve ETFs does have a reputation of maintaining consistent payouts, like we have seen with other ETFs such as UTS, Bank, and QQQY. Whether they are able to deliver a similar performance with BIGY, we will need to wait and watch. With that, we have come to the end of this video. As always, make sure to do your own due diligence before making any investment decision. The information presented in this video is based on my research, represents my opinion, and does not qualify as investment advice. If you found some value in this video, don't forget to like, share, and subscribe. I will see you in the next one.